Welcome everyone to our narration or explanation of Chapter 12. As you see in front of you, Chapter 12 is about NOLs, which doesn't mean a whole lot to you yet, AMT, and business tax credits. Certainly most slides are on the business tax credits, but we'll go through those fairly quickly. So let's dive right in and see what we have to learn about for this chapter. NOL is net operating loss. Typically, the tax law says whatever happens in 1 year stays in that year, meaning deductions, income, everything is it's treated as if there is like a wall on December 31st and January 1st that keeps everything that has to do with that year in that year. But there is this exception, and that is to try to give taxpayers a break that suffer some pretty sincere financial setbacks. Now, this is not for just having a problem, getting a reduction of hours at work or something like that. We're talking about negative income scenarios for net operating losses. So this is pretty serious financial setback. All right, and the only way you're going to have this, you can't get an NOL from working from wages, because you're not going to have to pay your employer. But you could have it where you lost money from a business, and that could happen whatever form of business that takes, whether that be a corporation, S corporation, partnership, or sole proprietorship. But that's what's going to cause it. So you're not going to see it if due to lots of personal deductions and so forth. All right, so you may have negative net income, negative taxable income, and not have an NOL. In fact, you probably don't have an NOL unless you have negative AGI. That's kind of the key that I like to look at. So, if you calculate all the taxable income items, you've subtracted out all the things according to what we've learned so far, and you have negative taxable income, how do you know if you have an NOL? Well, you start adding back things. The exemption, deduction, your personal exemptions, your dependency exemptions for kids, the $4,050 for each one has to be added back. That doesn't count in calculating NOL. Okay? Any non-business capital losses, anything more than your capital gains, is going to be not count. Now notice it's non-business. If it's a business asset you're selling, then it still counts, but not if it is a investment or non-business asset. Any NOL from past or future years is not counted, and you have to add back any non-business deductions in excess of non-business income. Now, non-business deductions include your standard deduction and any itemized deductions except for casualty losses. So you see here that they're both kind of highlighted here. Non-business income only involves really investment income. Wages and rental income are not part of that. So an example. Hopefully you can see this. Married, file joint return. They have a problem with their business. Maybe it's just getting started. I don't know. But they had revenues and $150,000 operating expenses. So the business had a loss of $30,000. He did have some salary income, or one of them did, for $15,000. They have some capital gains, some non-business capital gains, interest income. So those two are non-business income. We'll see that's important. They had a couple of itemized deductions. Really was a bad year. They had a casualty loss as well on top of the business loss. And there's your exemptions. So to get to your NOL, you start here and start adding back. You add back the exemption. We talked about that. We add back the difference between your non-business deductions. So your non-business deductions, except for casualty losses, $9,500. That's higher than your net business income, non-business income, I should say. And so by $4,000. So we add that back. We add that $12,100. Okay, so that's how the official way to calculate this. You can just see how we got some of the calculations where they came from on these next slides. Now, another way to think about this is if you were to start with the salary and the business loss and the business gain. So those are all your business items. So add, subtract, add. So that would be a -12. The non-business deductions are almost always going to offset non-business income. So they just offset each other. And then all you do is find the casualty loss, which is the one non-business deduction you actually get to leave in there. So you got 15, -15, plus 3 is -12, minus the 6,200 equals the 18,200. So that's a second way to do it, to check, make sure you're thinking correctly, which will come to the same result as long as you do it correctly. So once you've got that, you can carry it back 2 years and carry it forward 20 years, and you can elect to forego the carryback if it's not going to help you. It is reported as an adjustment to income on page 1, okay, as far as reporting. All right, alternative minimum tax. This is referred to as the AMT. This is a separate set of tax rules that have to be done for people whose income is on the, a little bit on the higher side. You pay the higher of the two, and we'll see how that works out. Either the alternative minimum tax or your regular income tax. Okay? So this is the way you do it. You start with taxable income before the exemption. That's the thing to remember, before exemption deduction and the standard deduction. Okay? Add tax preferences and positive adjustments, negative adjustments. We'll talk about what these are. We subtract an allowable AMT exemption, multiplied by the tax rate. And this is one place where it's simpler. There's only 2 tax rates. And then you compare it to your regular income tax to see if you actually owe the AMT. So, preferences and adjustments, the things that you need to remember need to be adjusted, added back, if you will, into our income. Okay. First of all, there are differences with having to do with depreciation. AMT uses a different process to do that, and it comes into play when there's no bonus depreciation or Section 179. Okay, so there is usually lower depreciation for AMT purposes. So you're going to add to your income the difference between the depreciation under regular tax and AMT. Okay, this will also affect your passive income and losses, and then there are some important tax exempt income. Remember, we learned that for bonds, municipal bonds, the income is excluded from tax and from your income. But if those bonds are used for private activities like building a soccer stadium, then they are added back here. They have to be adjusted, and your broker will have to tell you that that's a private activity bond. Difference between the exercise price incentive stock options, and then there's Section 1202 stock, which is something we learned about earlier as well. So these are, and there's some others that don't come up very often. These are the most common. If you make a note of these, you'll be able to deal with 90% of the situations that come up with AMT. Okay, you also do not get to count some of your itemized deductions, meaning they're added back to your income. Taxes, all taxes, that's the big one. That really hurts people who live in high tax states. So all your state income tax, local taxes, property taxes all get added back. Miscellaneous itemized deductions go away, okay? And interest on home equity loans. Now notice it's only home equity loan, not just regular interest on home loans, but home equity loans where the proceeds are not used to buy or improve the taxpayer's home. So if you do use it to improve your taxpayer's home, then you don't have to worry about this. for AMT. It's only if you use it to get a vacation or something other than fix up the house. Okay. Then you subtract the exemption. You'll see what the exemption is here. This is designed to keep most people from having to pay AMT. And here's the exemption. So you can see it's much higher than what we've dealt with in the regular, but it phases out. When your income gets too high, it phases out by 25% of the amount you're over the threshold. All right, and we'll look at an example of how that is calculated. Okay, so you start with head of household exemption, and this exemption changes every year. Okay, so you make sure you're using the 2017 exemption. Okay, 158.8 is over the threshold by 38.1. The threshold for head of household is 12700. Take that, multiply by 25%, and then subtract it from the exemption, and now your exemption is 44. So you see, as this gets high enough, okay, this is going to keep growing, and eventually it's going to be higher than this, and you're going to have 0 AMT exemption. Okay, now that is one of the easier phase outs because it's just straight 25% of amount over the threshold. Okay, once you have the income, you just multiply it by the tax rate, and then you only have two, like I said earlier. Okay, 26% on the first 187. Anything else is 128. So you only have to remember two rates, and there's just two tiers. All right, and then you compare it to your regular tax to see if you compare it to that. So here's our full example of how to do the AMT. Okay, AMTI, we take out the exemption. This is how you would calculate the exemption if our AMTI was on 193. Originally was 84.5 because we're married, filing jointly. Okay, we're over the threshold. 25% of that is 8,000. We subtract it, get the 76,425. Okay, we then multiply that by the 26% because we're not over 187. So that's your minimum tax. Your regular tax is 22.6. So AMT 7762 is going to go on the Form 1040, page 2, under Other Taxes. You'll see it listed there as AMT. Okay, so your regular tax will go under the tax liability line, and then the AMT will just be a couple lines below that. All right, so how does this all calculate out? You do it on the Form 6251. All right, I have a separate additional if you feel like you need even more about the 6251 podcast. It uses the 2016 form, but the only thing that changed is the amount of the exemptions, which are listed right on the form. So you just make sure you use the amounts listed on the 2017 form, but everything else, all the mechanics, is exactly the same. So you do it the same way. So here at the top is all your adjustments and preferences. You end up with your alternative minimum taxable income. Okay. This is where you do your exemption and any phase out of that exemption, although that's not entirely clear on this form. You kind of have to do that on your own. Remember that you need to phase it out because there's nothing that really explains how to do the phase out. And then you compare it down here to your regular tax, and then get the amount of the difference, which then tells you right there where to carry it onto Form 1040. Remember the second page. All right, so we'll end there our part 1, and part 2 will deal with business tax credits. So we'll come back and pick up there. Thank you.